I'm Tony Dwyer, Chief Market Strategist of Canaccord Genuity and Director of DwyerStrategy.com. Today, I'd like to talk about the second half of 2021. And we've been in the framework of believing that we're in a summer of indigestion. And we think that that summer of indigestion, which is not yet over, should create the year-end opportunity, especially when you look at the more cyclical areas. I think a lot of folks are focused on lately how the major market indices are making new all-time highs, but there's a lot of churning underneath the surface where it's really the mega cap secular growth theme is doing well at the expense of everything else. We have a core fundamental thesis at Dwyer Strategy, and it is the market moves with the direction of earnings. The direction of earnings is driven by economic activity. Economic activity is driven by money availability. That's driven by Fed policy, and that's driven by inflation, core inflation specifically. So let's go to the charts and see what they're saying. Well, obviously, the focus is on inflation. This chart here shows you the core PCE. There's a big debate on whether you use the CPI or the core PCE. And the answer is I don't really get into that debate. I just use what the Fed tells me they use. They use the core PCE. It came out at plus 3.4%, which is well above their 2% goal, and that's created a lot of angst. A lot of the effects of the core PCE are, in fact, transitory. Used car vehicles, airline cost, ticket cost, apparel cost, those things, some of them will fade where things like labor and owner's equivalent rent won't. So it's to be determined whether you're going to see an even greater spike in inflation. But for now, the long-term inflation break-evens, the second thing that the Fed says that they use, not only do they use the actual core PCE to measure inflation, they want to see what long-term inflation is acting like. Long-term inflation expectations have pulled back from the recent peak on talk of this tapering. So we're down from about 2.55% down to 2.28% on this chart. It's saying that the long-term prospects for another rampant inflation right now aren't there. And that has allowed the 10-year bond yield, which has come down from about 1.77% all the way down to 1.35% on this chart, where we think this is about to reverse. Not because there's going to be some kind of spike of inflation, but just like this move here reflected the strong economy and coming rampant growth, we think this drop is discounting being past peak growth, we're in a period of transition for the market. We're in a transition of monetary stimulus, fiscal stimulus. We're transitioning from peak growth. We're transitioning from peak earnings growth, right? This move up in the 10-year note yield, it discounted the strength. We believe that this move down is discounting a little bit of the slowing from peak. How do we know that? It's not my opinion. My opinion's good at being wrong. It's the data. What caused us to downgrade the cyclicals in March and April was that you've only twice in the history of the treasury market, only twice before have you had more than a 50% gain in the 10-week rate of change. It was in 2016 in December and 2013. In both of those cases, when you had your initial tick lower, it suggested that rates were going to drop. It happened right here, and it happened right here. You got your drop. Then when this indicator went from above 50, again, the 10-week rate of change on the 10-year note yield, to down below zero, a negative number, you ended up retesting those highs, even if it went lower later. So the point that I'm trying to make is, into the second half, there's expectations that the cyclicals can't work. The opposite of what was going on in March. When we downgraded them, everybody was long the cyclicals on the same side of the boat, thinking the bond yields were going to go to 2%. Now nobody can imagine retesting this high. That's what we think is going to happen. I think the most important thing that we can talk about is how does that affect Fed policy, especially with Jerome Powell's testimony and the market not knowing when the taper is going to happen. The reason this chart is important is every cycle has seen a lower peak in the real Fed funds rate. The real Fed funds rate is the real Fed funds using the core PCE. So it's the Fed funds against the core PCE. So if the core PCE is at 3.4%, guess where the real Fed funds is going to be? Between 3.1 and 3.4%. So here we are. You've never seen this kind of low since 1975. The point of this chart is to show you that you go into an economic problem. There's two reasons that the markets really see significant drops. The first is you have a perception of a coming recession. That happens when real rates are going up. You're coming out of a recession and beginning an economic cycle when real rates are making their lows. We are still making our lows. This suggests that the Fed remains historically accommodative. And we know that because that we're not near a recession because there's been no dislocation in everywhere else. Similar to when people say the market's doing something, they're quoting the S&P 500. I think you have to define what market you're using. If it's based on the S&P 500, which has about 10 stocks dictating its performance, I'm careful with that. The same when the 10-year note yield is telling you something by dropping, and they're thinking that it might be recessionary. Well, somebody better tell every other area of credit. This is the agency spread to 10-year Treasury, mortgage spread to 10-year Treasury, investment grade, and high yield relative to the 10-year Treasury. And it's suggesting that there's no dislocation anywhere in the numbers. Not only that, when you look at we call it the corporate fear index, we look at the junk bond yields in blue relative to the Moody's BAA and the dashed black line. Both of those are at historic lows. I mean, think about this. You've got high yield debt below 4%. Speculative grade debt is below 4%. Wow. That's not what happens in a recession. This line goes up prior to recession. So I said there's two ways that the market can go down. And sense of a recession is coming. Clearly, that's not the case. Or you have a market event, a Volmageddon. Remember the volatility situation in early 2018 when the volatility quant funds blew up, or the flash crash in 2010. You get a market that's kind of lined up for an event where there's deterioration underneath. And I think in the summer of indigestion, we're kind of in that potential. I don't know if we'll get that kind of hit, but it feels like with most stocks lower relative to, actually, when you look at the S&P 500, it's making new highs, and at the same time, only 50% of the stocks in the S&P 500 are even above their 50-day moving average. So the market's been indigestion for a couple of months. It could come around to the rest of the index. What's been historic about this cycle is the amount of money that's been made available. This is your money supply growth. So we have inflation expectations have come down. The 10-year note yield has dropped. The Fed is super accommodative, and that's creating historic excess liquidity. Remember our core thesis. Markets driven by the direction of earnings. That's driven by economic activity. That's driven by availability of money. That's driven by Fed. That's driven by core inflation. Core inflation expectations, long-term inflation expectations are benign and coming down around where the Fed wants them. The Fed is super easy. We just looked at that on the real Fed funds rate. And there's huge money availability in the corporate bond market. Yields are at a historic low, and money supply has got over 25%. That's way higher than any other post-World War II point in our country's history. It has since started to come down. So when you look at what real liquidity, excess liquidity, people always say the market's been driven by excess liquidity, and it has. You had a huge ramp off the low to a historic degree, just like you did after the great financial crisis. You had a huge ramp off the low to a historic degree, just like you did after the dot-com bust and 9/11 crisis. You got a huge ramp to a historic degree. So we're not reinventing the wheel here. Once you get that huge ramp, what happens, government going into a recession, it's unique every time. Going into the recession, you had, in my career, I had the S&L crisis with Michael Milken blowing up the high yield debt market. We had the dot-com bust. We had the great financial crisis, and now we had the COVID-19 pandemic. Four very different reasons for going into a recession. While it's unique every time that you go into a recession, the response is always the same. The response is to throw as much money at it as you can. And that's what we did. Huge money supply, huge equity and bond mutual fund growth. This red line measures money supply growth plus equity and bond mutual fund and ETF growth against industrial production. So it's basically readily available money versus what you're using to produce economic activity. What happens is early in a cycle, you get this huge, they throw as much money as they can, and that goes into investment. But eventually it starts being put to work into economic activity. That's why this is coming down. It's a good thing. It's telling you that the cycle's working like it's supposed to work, but it also creates that period of indigestion we talked about. We know that it's being put to use in economic activity because the industrial production is ramping. Again, this shows that the money that was given, that excess liquidity, is going to work in economic output. We also know that we're early in the economic cycle because national financial condition sub-indices from the Chicago Fed that track 105 credit stress indicators have continued to improve following the Fed's historic intervention. You are still easing financial conditions. That's also reinforced by the net bank lending practices to business. This blue line is large businesses. The dashed black line is small businesses. It's those that are tightening standards above this black line, easing standards below the black line. Doesn't this look an awful lot like what happened after the great financial crisis and after the dot-com 9/11 crisis? Again, the answer is always the same. Unique reasons throws credit into chaos, creates a recession. The same answer takes us out of it. Throw money at it. So economic activity is picking up. We obviously had a historic shutdown early in 2020 and a historic recovery coming off of that. And now we're seeing a little bit of a more normalized level above average. That's been reinforced by improvement in the weekly employment data, where you're continuing to see a trend lower in initial jobless claims and continuing claims. Non-farm payrolls, aggregate hour work, they keep trending higher. And what's really good about this cycle is it actually has a demographic tailwind. The number of millennials turning 30 matched the number of baby boomers during their peak birth year at about 4.1 to 4.2 million. We're only 1 year past the peak, so we actually have a demographic push into those that want to move into housing. Nobody wants to have car leases and home mortgages and all the expenses associated with a household until they build a family. Those families are being built, and that's creating increased home ownership. When you look at the renter occupied housing units in blue, you had a high level followed by a historic plunge. You can see this in the red line in the year over year change. And on the other side of the trade, you had the owners of the housing units versus the rental units. Housing units in the green dash line had a historic spike. So this is all economic output that is not only directed by manufacturing, which I'm going to show you in a second. It was a push into housing by the millennial demographic. Very, very good. And they can afford it. The household debt and financial obligation ratios hit historic lows on the back of the monetary and fiscal stimulus measures coming out of the pandemic. These are incredible numbers. And going all the way back, you've never seen this level of affordability as it relates to debt versus income. Small business activity, optimism is recovering, and we're in a new manufacturing cycle. So this top half of this chart is the manufacturing production index. This, it's a down arrow when the Institute of Supply Management, the PMI survey, ISM survey, when it goes from above 54 to below 45, you get a down arrow. You get an up arrow when it goes from below 45 to above 54. Well, guess what we just did last year? We turned it into a new economic cycle, which it happened very quickly. As you can see, anytime that's happened over the last 40 years, it's been a pretty good sign for economic activity. Not only that, your non-residential construction spending is going to pick up according to the AIA Architecture Billings Index. It's, you gotta propose how to build something before you actually build it. Well, this works with a 9-month lead time where the Architecture Billings Index leads the non-res construction by 9 months. That's just beginning to pick up. In addition, you have increased global activity. It's not just a US story in the pandemic. The breadth of OECD, Organization of Economic Cooperation and Development, the composite leading indicators, they track 35 countries. The share of those composite leading indicators of those 35 countries showing expansion versus contraction continues to increase. It's stayed healthy on a month-to-month sequential basis. And obviously on a year-over-year basis, it's hard to get above 100%. And the only other time I can see that you've done that in recent modern era here is back coming off of the great financial crisis. So again, all these are signs that you're early in an economic recovery. Yes, the market has to go through some indigestion when you're trying to figure out the transitioning monetary policy, when you're trying to figure out the transitioning from peak growth, when you're trying to figure out the transition between growth and value and growth. Ultimately, it comes down to the market follows the direction of earnings. That's driven by economic activity. Economic activity looks pretty sound, and earnings activity as a result of that is pretty sound. This chart, as you know, I'm all about showing you data versus giving you opinion. This chart here shows you the S&P operating earnings versus the S&P 500 index. The correlation is a 0.936. The market correlates with the direction of earnings. You have to make a negative direction of earnings for a sustainable drop in the market. Can you have a 10% correction? Absolutely. You normally get them. But it's what you do with it that's important. And again, if you believe we're early in an economic cycle, then you want to be buying any dips because you really need a recession for negative earnings. And that's highlighted here in this chart where you're having your peak earnings growth is 65.8% based on the current consensus. But look at the out years. You're still in double-digit earnings growth through the beginning of 2023. Our current estimate is 195. The street's currently at 191. So I think that you will be beating expectations. And the last chart that I want to throw your way is the valuation chart. Many people feared that we're like the year 2000 when we got up to about 28 times earnings on trailing 12-month earnings. And I didn't believe that. I believe we're a lot more like 2010. In 2000, yes, we had similar valuations, but not only did you have a valuation compression, you actually had an earnings compression. What's happening here is you're getting this valuation compression similar to 2010 when you had a 12% up year in 2010 and earnings just way outpaced the price of the market. We think that's going to be the same case here. Historically, when core inflation is between 1% and 3%, you trade at least an average of a 19 to 20 multiple. We think that's around fair. Could it be? I don't want to get into where it should be because that's a total guess. What we do know is that our core fundamental thesis that's driven by earnings, which is driven by economy, which is driven by money availability, which is driven by Fed, which is driven by inflation. All those pieces are in place to take advantage of this transition phase that's creating the summer of indigestion. I'm Tony Dwyer. If you have any questions on this presentation, you can always go to dwyerstrategy.com and take a look and sign up.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.